Welcome and get ready to dive into the thrilling world of investments, where numbers dance, money talks, and the unexpected always keeps us on our toes. Schwab US Dividend Equity ETF, or SCHD, is one of the most popular dividend ETF for investors. But have you noticed SCHD is lagging the broad market in 2023? While the S&P 500 is going gangbusters with almost 20% appreciation from January to July, SCHD is completely missing the rally, and even losing about 1% in value. That's a pretty big difference. But why is this happening? If you have SCHD in your position, should you continue to hold this ETF for a bounce back? Or is there an alternative investment option that could offer sweeter returns and lower risk for the time being? We looked at SCHD in detail in a prior video, and you can check it out here. Today we are going to recap some of the highlights of this very popular dividend ETF. This ETF has been around since 2011 and has a massive $47 billion in assets under management. Its expense ratio is super low at just 0.06%. At the same time, it offers a juicy dividend yield of 3.58%, beating out many other dividend ETFs out there. The large dividend yield is the single reason many investors liked SCHD. It also helped the ETF achieve higher total returns over the years compared to other dividend ETFs. But things started to change in 2022. The one-year return of SCHD at 5.1% falls behind its category average of 10.83% by a large margin. The trend continues into 2023, where SCHD experienced a decline of 2.11% in the first 6 months, while its category benchmark gained 4.47%. In fact, SCHD's recent return is so disappointing that it falls at the bottom 25% within the Morningstar category. So, what do you think is causing all this? While SCHD had a great historical performance, its trailing 12-month dividend growth rate has slowed down to just 7%. That's below the median for ETFs in its category, which is 15%. This is because a bunch of companies within SCHD's holdings are actually experiencing a decline in their earnings growth. That drop in the dividend growth rate can mean some not-so-fun stuff for the companies in the ETF. It could indicate a slowdown in their earnings growth. As you know, dividends are usually paid out of those earnings. So, if the company's growth rate is going down, their dividend payouts will also be negatively impacted. Take a peek at this chart showing the price returns of the top 10 companies within SCHD's holdings, representing over 40% of the fund's assets. Since 2023, only a few of them have managed to appreciate in price, while the rest are just flat or losing value. Our next question is, why are these companies hitting a rough patch? Is it because of a weaker business environment, more competition, or industry-specific challenges? Understanding these factors can help us decide whether we should continue holding SCHD. But before we dive in, if you like what you see here, don't forget to hit the like button below and subscribe to our channel. Alright, let's continue. By and large, these top 10 stocks in SCHD have had an average revenue growth of 5.4% in the past year. But guess what? When we look at the core inflation rate over the same period, it's pretty much on par with the revenue growth of these businesses. That means there hasn't been much real revenue growth for these companies after taking inflation out. As a result, that flat growth may have contributed to the underperformance of those underlying stocks. In stock valuation, there is a metric called the PE ratio, which stands for price to earnings. It's a way to figure out if a stock is overpriced or undervalued. Now, based on the PE ratio, we can calculate something called the PEG ratio, which means, as the name suggests, the price earnings to growth ratio. It is calculated by dividing the PE ratio of a company by its annual earnings growth. For example, if a company's PE ratio is 20 and their growth rate is 10%, the PEG ratio is 2. A PEG ratio of 1 usually implies the stock's valuation is just right and in line with its expected growth. A PEG ratio below 1 suggests the stock might be undervalued, and above 1 could mean it's overpriced. Now let's check the PEG ratio of the top 10 holdings within SCHD. As it turns out, the majority of the top 10 holdings within SCHD has a PEG ratio well above 2, indicating these companies are overpriced in terms of their projected earning growth. This is not good news for investors who hold SCHD. Next, let's take a look at the sectors SCHD focuses on. Industrials, healthcare, financials, and consumer staples are the top 4 sectors. Together they represent more than 60% of the portfolio. But 2023 is the year when the tech stocks rally, and SCHD's composition largely missed out the opportunity. By the way, we discussed in a previous video why 2023 is the year for the tech stocks to rally a few months ago. Feel free to check it out here. We also discussed in a previous video that SCHD's industry allocation makes the ETF better suited for a recessionary environment. Consequently, when the market is rallying for growth, SCHD will underperform. So what are the alternatives for investors who don't want to chase the market, which is already up so much this year, but at the same time want to have better returns than SCHD? If you are focused on income generation, a covered call ETF such as JEPQ would fit your needs. Comparing JEPQ to SCHD in 2023, the performance difference is astonishing. JEPQ, which regularly sells call options on the Nasdaq 100 index, delivers a total return of 25% year-to-date. Had you invested in JEPQ, you would not miss out the market rally taking place in the tech sector. I know not everyone is a fan of those covered call ETFs, and there are still fears that the recession is likely to hit the broader economy in the second half of the year. So for folks who want to be more defensive while getting decent earnings, you can consider short-term money market funds. For example, the Fidelity Government Money Market Fund Premium Class, ticker symbol FCCXX, has a 7-day yield of 4.85%, while SCHD's dividend yield is 3.6%. By parking your money in a money market fund, not only do you earn a higher yield, you also get to preserve your capital. Money market funds are also very liquid instruments, so you can transfer the fund to make new investment quickly when the opportunity presents itself. Today, we explored the challenges facing SCHD ETF and offered a few alternatives to earn better income depending on your risk tolerance. If you found this helpful, subscribe and share your thoughts below. Thanks for tuning in. Stay informed and happy investing.